On the show, we'll be assessing Africa's role in global trade. As always, you can join the conversation with the hashtag Beyond Markets. You can also follow my Twitter handle too, at Esther Budaga. Now, the World Trade Organization forecasts world merchandise trade volume to rise by 3.6% in 2017 and to 3.2% this year. According to the United Nations Conference for Trade and Development, Africa accounts for a very low share of world trade, and the continent's export share as a proportion of global exports has been decreasing steadily. So how can Africa overcome the factors that continue to hinder trade in the region? Well, my guests for this discussion are James Gearin, Director at Texel Finance, and John Lentaigne, Chief Underwriting Officer at the Africa Trade Insurance Agency. Thank you, gentlemen, for taking the time out to join us. John, apologies if I didn't get that right. But let's start with your perspective on global trade and how Africa comes into the picture. We know that there's been that movement against globalization, making many regions, many countries to now look inwards. But of course, global trade still exists. But statistics still point to Africa not having a large share of global trade. John, let me start with you. What is your perspective in terms of those factors that continue to hinder this from happening?
It's an interesting question. I mean, I think on the one hand, you do hear a lot of African leaders talking the talk and saying the right things. Not all of them, but certainly some of them. And it's interesting to see the positive developments in Zimbabwe recently, for example, or the Open Skies initiative that was announced this week. From our point of view, this is great stuff and is exactly the sort of thing that Africa needs to do. Be more open to investors, more investor friendly, remove barriers to investment, remove trade barriers, regulatory barriers, etc., etc. So there is positive initiatives going on. But I think on the other hand, we all have to recognise, as you say, that Africa's coming from quite a low base relatively. So there's a lot of work to be done as well. James,
your perspective?
Yeah, so from the institutions that we work with, we actually see the amount of investment that's coming into Africa and the value of trade increasing year on year. So it's interesting to hear some of the statistics that you've mentioned there are potentially counter to some of the things that we see from our sort of financial institutions that we work with.
Okay, but John, let me come to you again. I'm just thinking, so how, from the narrative, the conversations you hear among African leaders in terms of how they're trying to ramp up trade, that on one hand, and on the other hand, also trying to boost intra-African trade, that's still also low. I mean, 15%. We see countries in Africa trading more outside of the continent than within the continent itself. So how do you see countries balancing both, trying to get a share of the bigger pie on the global scene and then also trading within the continent?
Again, a good question. I mean, one looks around and one sees contradictions. So, for example, in East Africa, where ATI is based, we're based in Nairobi, it's quite easy to move around relatively country to country. You can turn up, get visas. On the other hand, in West Africa, it's incredibly difficult to get visas. And these are little barriers to trade, but it does impede things. Another interesting example, I noticed that for the Open Skies initiative, quite a few countries didn't sign up to that. And a number of these countries don't even have a national airline. And you sit there thinking, well, why wouldn't you want to do that? You don't have a national airline. Is it some vested interest that we're not hearing about? It's continuously challenging, often perplexing, and I think the mixed messages is definitely an issue as we see it, and often from government. When I look around the continent, there are very few governments that are unashamedly, consistently pro-investor. And I think those countries that tend to be quite emerging champions for that reason, because investors are desperate to invest in Africa, and yet they see these barriers and they get mixed messages and uncertainty.
Now, James, when we talk about exports, and we talk about trade, we talk about exports, obviously the issue of credit comes in, risks, political risks. So tell us from your perspective in terms of credit risks, as it were, what are the trends that we should look out for that are happening now?
It might be interesting to hear a little bit about what Texel does and the role that we play. So we have offshore financial institutions, funding entities that are looking to invest in bankable projects in Africa. Texel acts as a conduit, really, for those institutions to mitigate some of their concerns about investing in Africa with institutions like ATI that John represents and offshore insurance companies that will look to partner with those financial institutions to increase the level of investment that they're looking at into various African countries. I think John was mentioning that there's only two African countries that are of investment grade status. So if you're sub-investment grade and you look at it from a lender's perspective, it limits the value of transactions that they can actually look at financing. So with the help of private market offshore insurers, ATI working with multilaterals, agencies and DFIs, the value of that investment and the number of deals that they can look at really starts to go up. So that fundamentally is this concept of investment insurance that sits alongside the funding.
But on that point of credit risk, I think what's interesting is almost universally across particularly sub-Saharan Africa, but even Northern Africa as well, debt levels have increased substantially since the crisis. Actually, this is a global trend. But in an African context, what you have is a lot of sovereigns who don't have a huge revenue base. They don't have high GDP per capita, so there's limited scope to increase taxation. And from our point of view, that is a concerning trend, because with high and elevated debt levels and with US interest rates looking like they're going to rise and a lot of borrowing having been offshore dollar-denominated debt, it's conceivable that we could have another African debt crisis, or at least a crisis in some of the African countries. So that is concerning at the moment, and obviously that trend is concerning to investors as well.
Well, that's quite interesting, because we know that this is also a time where many African countries are trying to ramp up investments into infrastructure.
Often through borrowing.
They're pulling funds. I know you've given out some, may not be exactly what you do, but I know that you also you've made a good reputation for yourself, getting syndicated loans, helping, like you said, providing the cash flow to the lenders, if I'm correct. So I'm just thinking, how does all of this?
Well, no, it sits together perfectly. I mean, the demand for credit insurance, investment insurance, is high because their appetite. Effectively, you've got financial institutions that are looking for those bankable projects into Africa. Okay, the margins that they're looking at, based upon the cost of capital for these financial institutions after the financial regulation, after the financial crisis 2007, 2008, the cost of capital increased due to the regulatory environment. Okay, so when you're looking at emerging market investments and transactions based upon the sort of margins that are available for those deals, you need to start to think about other methodology of syndicating some of that risk. The value of deals now is, it's easy to get in excess of $1 billion. Okay, so these are high sums for banks to take on their own balance sheet. So they look to syndicate and share that risk with other well-rated entities to reduce the cost of capital associated with those deals. And John's credit rating for the firm that he represents, ATI, is A-rated. A lot of the institutions that we work with are A+, AA- rated. Okay. So the value of that paper is super high for those offshore investors looking at African deals.
Interesting. But I mean, apart from credit, John, there's also political risk, and there's political risk insurance. And I know that sort of gives companies here, foreign companies in Africa or wherever they find themselves, especially on the continent, some confidence, because they can focus on their core job while they're there, and then let the insurers carry that burden or that risk. Explain that to us.
I think that's absolutely critical, and it's not a point that's that well understood. I mean, we understand it, we operate in this narrow world that does, but even amongst the broader financial community, and certainly at government level, for example, I think the critical support that is provided by political risk insurance, investment insurance, is not properly understood. And simply put, more or less every major investment made into Africa will have investment insurance or political risk insurance sitting behind it. And this insurance mitigates one of two things broadly: either the payment risk on the borrower, which might be a government or it might be a corporate, or the political risk, which you touched on. And the political risk largely is government risk. So we're talking the risk of governments renegotiating contracts, breach of contract, confiscation of assets. And then Ancillary to that, which is a bigger factor in some countries than others for obvious reasons, is political violence risk and war risk. And if you don't have the insurance products that we provide, these investments just won't go ahead.
Yeah, it's important to look at the drivers as to the different types of products. So inevitably, if you're making an equity investment into Africa, physical assets, then political risk insurance is going to be more relevant to you.
But do many of these players, do they recognize that it's important and that they need to have it as they go in?
It can't happen without it. I think that's the key point. So for example, ATI, we're a multilateral institution, so we're owned by African governments as our major shareholders. One of the biggest investments into DR Congo last year was a mine in eastern Congo, and that investment simply wouldn't have happened without the political risk insurance that we provided. So as James said, that's an equity investment. Equity investors, actually added to that were lenders, debt investors, but combined, although they like the dynamics of the particular mine, without political risk insurance, it's simply not going to happen because the perceived or real risk of DRC at the moment is perceived to be too high. So if you don't get the political risk insurance, the project just won't happen.
It's there to try to the value of capital, if you look at sort of funds in the US, pension funds in Europe, etc., they're all looking for homes to get a return. The returns in Africa as an emerging market can be really attractive. But the hurdle is, to a large extent, some of the political risk there. So if you can start to negate and reduce that concern, then it really opens the doors to a huge amount of private capital that can flow in. And equity investments in some of these countries is key. One of the things that John and I were talking about actually before the programme is the value of transactions that John has helped happen in 2017. And I think some of the figures, it might be useful for you and your audience to hear about some of the figures.
You know what? We'll talk about these figures when we come back. We need to take a quick break. Thank you for your time so far. Great having you in the studio. I've been speaking to James Guerin, Director at Texel Finance, and John Lentaigne, Chief Underwriting Officer at the African Trade Insurance Agency. As we continue our focus on Africa's role in global trade, still with me in the studio are James Guerin, Director at Texel Finance, and John Lentaigne, Chief Underwriting Officer at the African Trade Insurance Agency. Thank you, gentlemen, for your time so far. James, let's talk about those numbers you were going to tell us. Let's pick up from there.
Yeah, sure. I mean, John, you talk about your numbers, and then maybe I can add it from a sort of private insurance perspective.
Yeah, no, okay. So last year, ATI, African Trade Insurance Agency, which is Africa's multilateral investment insurance agency, we insured policy limit of about $2.5 billion. So that's trade and investments, largely foreign direct investments into our member countries. And we reckon that on average we insure about 1% of GDP every year in our member countries. So the cumulative effect of that is quite substantial. And of course we work with entities like James to access the international markets who provide additional capital to us.
Yes, it's quite tricky to get a real firm fix on the figure, but we think that the number is closer to sort of 40 to 50 billion in terms of value of transactions that the private insurers have supported for offshore financial institutions investing into Africa.
And that's annually. But
what are some of your, major challenges working with insurers like John's company, but what are some of your own major challenges?
Speaking to our clients, bankable transactions is key. There has to be the ability for the debt to be repaid. It's got to work. Ultimately, they're all looking to make a return for their stakeholders. So the transaction needs to make sense. So a lot of transactions, given the resources in many of the countries, are commodity focused. They have a commodity angle.
And that can be tricky because...
commodity value fluctuation? Yeah, for sure. So you asked for some examples of some of the transactions. Pre-export finance transactions, reserve-based lending deals, particularly in the oil sector, are many of the types of deals that our clients look to finance. They're proven, they work. It's a good example actually because of the oil price fluctuation. Certainly when some of these transactions are put in at $140 per barrel as they were a few years ago, and it goes down to 50, 60, those deals start to get stressed. You've got a combination of offshore financial institution lenders, local banks, ECA financing, which we'll touch on, multilateral agencies that are all investing in these same transactions. So restructurings need to take place. which have been happening, and they have been working and performing. Nigeria is a good example of that. There are other transactions in other countries as well.
So touching on Nigeria, I think another particular challenge for investors looking to go into Africa actually is that in certain countries there is insufficient investment insurance capacity. And that may be for various reasons. If the government has borrowed very heavily, most of that debt will have been insured in the investment insurance market. And the effect of that is that the government starts crowding out the private sector. Because naturally, as an investment insurer, you tend to take the best risk, which is often the sovereign. And therefore, it's very hard for investors to invest in the private sector because there is no capacity in the investment insurance market. This is definitely true in Nigeria, for example, Ghana, Angola, to some extent Kenya, Zambia. These countries are all affected by a lack of investment insurance capacity.
Interesting. You want to add to that?
No, John's absolutely right. I mean, the reality is there needs to be greater progress done in the due diligence level to effectively go, you talk about going down the credit curve, but go down, try to get away from pure government, sovereign or sub-sovereign risk. And that's not easy to do. In a way, there's an expectation that should be fulfilled by the local banking sector, but I'm not sure whether that's actually being achieved.
Okay, all right, John. I want to ask you: do you think that export credit agencies should play a bigger role? Is there room for them to be a lot more flexible?
Well, it's interesting. I mean, ECA's export credit agencies do play a major role in funding African investment. The biggest for sure is Sinosure out of China. They stand behind huge volumes of inwards Chinese investment, and they do so at very competitive pricing. But the Western ECAs are very active as well. UK Export Finance, Sarche, Euler Hermes, etc., etc. Equally, they're all capacity constrained, as are the multilaterals, institutions like mine, and as are the private sector. So people talk about the funding gap in Africa. There's also a gap in investment insurance capacity, I think, naturally. And I don't know, is it resolvable? It's a hard question because fundamentally, the lack of capacity often comes around because of the low credit ratings or low political risk ratings of the African countries. So obviously with good governance and as countries increase, it's easier to access more capacity.
I was going to say exactly the same as John, sorry. If you look at the countries that have been successful in doing that, governance and framework is super important, and that's driven from the top down. I mean, Mozambique, for example, is going through a restructuring process. So for the time being, it's difficult for finance providers, ECAs probably, to get approval to start doing big ticket deals there.
Almost impossible, right?
Absolutely, almost impossible. And then there are other countries at other ends of the spectrum that are doing some great things.
Well, I think Ghana is interesting on that.
For the issue of lack of capacity, because obviously that's a big problem. You don't see anything being done to address that?
Well, I mean,
if we're going to expand the whole, trade and all of that, but I'm thinking we have to address that before.
Absolutely. Well, I mean, one thing we're encouraging is for more African countries to join African Trade Insurance Agency, my institution, because at the moment we have 14 member countries with a population of around 500 million, but there are many countries that haven't yet joined our institution. Fortunately, this year Nigeria has applied to join ATI, which is a great step forward for us as we move into West Africa. We're talking to the Ghanaian government at the moment, Angola, and we'd like to talk to Egypt, etc. So one obvious thing is join the institutions that can immediately bring you additional capacity. Because the private sector, whilst they are huge capacity providers, naturally they're already providing as much as they can unless you suddenly find new investors coming in.
But they have a knack for looking for or identifying opportunities. In the space, I'm just thinking.
Yeah,
so what
absolutely.
opportunities
ultimately, the private investment insurers are typically silent. Okay, they sit behind those financial institutions.
Okay.
John is different in terms of the entity that he represents and works for because he is a public multilateral agency that is owned by government. So he can afford to be. It's in his interests to be highly visible. Typically, the private investment insurers have never wanted to be as visible because they are deemed as a silent risk taker. They sit behind that financial institution to work on their behalf.
Okay, now I'm just trying to picture, Trade Africa and the institutions that support them, insurance, providing that risk, that cover. I'm just thinking 10, 15 years from now, those bottlenecks, how do you see them being addressed? And how, I mean, because obviously as you also look forward, you also have to take that into your strategy in terms of how the market is going to shape out for you to be a better player. And I'm just thinking, how do you maneuver that?
No, it's a good question. I mean, how are we going to fix these bottlenecks? Well, I think a lot of it comes down to governance and improved governance. As governance improves generally across Africa, obviously there's mixed trends on that front, but I think those countries that make a real effort to improve transparency, stick to the rule of law, improve the investor environment, etc., capacity will naturally augment in those countries anyway, because the risk takers, many of whom are ultimately insurers, along with the financial institutions who are lending, will be much happier to lend to countries that go along that path. So there's a huge amount they can do.
In the meantime, you just wait, right?
No, I think there are some changes, John. I mean, we've talked about it. Transparency is absolutely key. Fortunately for John, he gets to talk at a really high level of MOF. And there are some examples that you provided of ministries that really understand what you're trying to do, and that makes your life easier, I think, in a way.
Yeah, for sure. I mean, we definitely see, without naming names, but some countries are just that much more progressive, transparent and open, and it's a huge help for them. It's a win-win, I think.
Going for, what is your strategy? I mean, what is your strategy for the market the next 5 years?
So for ATI, we're very focused on a membership push. We've had 4 new member countries join our institution in the last couple of years, including Côte d'Ivoire, Ethiopia, Zimbabwe, and most recently South Sudan, which is clearly a challenging country, but it's one we can definitely help. We are focused on moving into West Africa, and that's why we're talking to Nigeria and Ghana at the moment, for example.
Are you excited about West Africa?
Very excited. I mean, the opportunities are huge, because going back to that point, there's a huge dearth of investment insurance capacity. But if you combine joining institutions like ours, openness, transparency, bringing in the private sector, and another initiative that I'm actually interestingly working on with James at the moment is we're trying to talk to pension fund investors who historically have shied very clear of Africa, and talking about European Western pension fund investors. Well, they just haven't been able to invest because of the sub-investment grade hurdle. But we think that's a huge potential new source of financing for the continent.
Absolutely. Yeah, I mean, Texel Finance's role is not one of origination. So to a certain extent, we are limited a little bit by our clients' coverage and the transactions that they look at. So in a way, we are relatively reactive. What we do see, though, is a greater push from the big 3 or 4 multilateral agencies and DFIs, and supporting their push to do more, to expand the use of their balance sheet and their capital without having to raise more. So we feel like actually it's the onus is upon them to go out, source transactions, and we can provide support to help manage their risk profile. Okay,
now back to our core. Because the topic of this discussion is, Africa's role in global trade, Africa getting a bigger share, and then of course we've talked about all the intricate details, credit risk, insurance, and all of that. But as you go forward, because I'm thinking it's also material key to your business too. If Africa is able to expand in terms of capacity and then do more in terms of trade, global trade, not just even within obviously the opportunities within the continent. So are you hopeful that we can see that traction going forward? Not just within the continent,
but globally, exporting globally. No, I think so.
James doesn't seem to.
Well, no, absolutely, I do. But the problem is it takes time, and it takes an investment, because you don't want to be a constant sort of economy that's importing. Okay, there needs to be, otherwise the deficit just keeps growing and growing and growing. There are certain companies that have the ear of certain investors, agencies, ECAs that are looking to put in place an infrastructure for plants that actually do a lot of the processing and then the exporting out of Africa. There are some examples that I know of, but there aren't enough. And it really means getting away from some of the lending on a sovereign, sub-sovereign level, and going down into backing private corporates.
I couldn't agree more. I think this is all ultimately, the private sector has to be crowded in. And earlier you were talking about DFIs and multilaterals. I represent a multilateral, but we're hugely aware that the key to unlocking both more inwards FDI and ultimately outwards trade is getting the private sector involved.
Absolutely. Thank you so much, gentlemen. We're going to have to leave it there. Thank you for your time today. I've been speaking to James Guerin, Director at Texel Finance, and John Lentaigne, Chief Underwriting Officer at the African Trade Insurance Agency.